All right, we've talked about remeasurement and we've talked about translation, kind of theoretically, but let's see if we can get a little bit more definition about, well, what is remeasurement? And then we'll talk a little bit more about, well, what is translation and how do you do these things? So let's talk about remeasurement. And actually, you've already been doing some remeasuring of foreign transactions that are not in the functional currency. Do you remember all those? We did a cash balance. We did sales and receivables. We bought some inventory. And we had a payable associated with it. We had investment securities that were denominated in a foreign currency. All of those were transactions. All of those were recorded. And were initial transactions that were in a foreign currency. And all of them had to be remeasured into the functional currency. So now what we're talking about an entity or an organization that all of their transactions haven't been remeasured as we went along. They have just been, they're sitting in their own recorded currency. And now what we're going to do is we're going to en masse take a look at that income statement, the balance sheet, cash flow, statement of changes of stockholders' equity, as well as other footnotes. And we're going to remeasure everything that happened, right? So that versus what we were doing, which was looking at an individual transaction and remeasuring those individual transactions. So let's go to our literature. Let's go over to our foreign currency matters. And let's take a look at overall. And we want to take a look at other presentation matters here. And I really we've talked about functional currency. This is all, we've already looked at a lot of this stuff. I'm not really there's a lot of discussion about highly inflationary economies. We're going to hold that in abeyance. That's a special circumstance. We don't generally have highly inflationary economies, so let's kind of keep it based on basic blocking and tackling. And let's come down here to 45-17. So this is 830-10, 45-17. And what it says, it's the very first line, if the entity's books of records are not recorded in the functional currency, you have to remeasure into the functional currency, right? Just like any of those transactions we were doing, if those transactions were not in the functional currency, they had to be remeasured into the functional currency. With those previous transactions, we did them every single time we did a transaction. Here, the entity isn't going to be doing these remeasurements every single time they do a transaction. They're just recording everything in the foreign currency. So everything has to be remeasured. But now we have this issue, right? Because some of this stuff is not going to be affected by future cash flows. So when I buy a building and I paid €1 million for it, right? That whatever the date is that I bought that particular building or that particular piece of property for the €1 million, €10 million, whatever the number is, I don't care, right? If the euro is not the functional currency and say the US dollar is the functional currency, on the day I bought that building, I should know how much I theoretically would have spent in US dollars. It is not going to go up and down in value. It's a building. There's no currency effect on that building. So when we look at remeasurement from the recording currency into the functional currency, and then hopefully that's also the reporting currency, non-monetary assets, right? Non-monetary assets need to use the historical exchange rate on the date that those particular items were purchased or sold or what have you, right? Whenever they were purchased. So these are the different kind of accounts that need to use historical exchange rates. Everything else needs to use the current exchange rate, whatever the current balance sheet spot rate is for that particular date. Everything else right? Other than these things that are listed, everything else needs to use the current rate. So here are the things that need to use the historical exchange rates. Now, I can tell you right away, this is not right. I can tell you that because if I go down and take a look at 4518 and look at the transitional guidance, you will see that 4518 has this transitional guidance. Because the literature has changed on equity securities as well as available for sale securities. Right? Both of these, right? Both of those items are now handled differently. And so you always have to be looking at your transitional guidance, right? So different types of equity securities, ones that do not have a ready market value, those you can use historical rates. But if it has a ready market value, all of that fair value change from the purchase of equity securities in the current literature, all of that goes through income, which would include the foreign currency exchange rate. So everything related to equity securities already goes through fair value, right? So if this is in the euro, then all those equity securities with a fair value, any of the exchange fair value also has to go through income as well. For debt securities, for available for sale securities all go through OCI, and you need to use the current rate. The only time, and this is up here a little bit, we kind of blew by it. I think it's up here. It's not in this one, but there is a area where it talks about available for sale securities. With available for sale securities, the only thing that goes through income are credit losses, right? Everything else goes through OCI. So inventories carried at cost, prepaids, property, plant, equipment, goodwill, patents, all of these items are non-monetary items and require use of historical rates. Okay? Revenue and expense items related to cost of goods sold, right? That's using inventory, right? We're getting rid of the inventory, that's cost of goods sold. That's a non-monetary item. Depreciation of PP&E, amortization of intangibles, amortization of deferred charges or anything like that. None of that, all of that should be using the historical rates, right? Everything else should use the current rate. And any of the gains or losses from this remeasurement need to go through the income statement of the subsidiary that is being remeasured into the functional currency.